Hi everybody, I hope you're doing well. Today we are answering some questions that come up all the time about deducting expenses for your vehicle. First of all, if you are an employee of a business, including if you are an employee of your own S corporation and you are using your own personal vehicle for your work, there isn't a tax deduction for that on your personal tax return. Make sure you're tracking your mileage. Your employer should reimburse you for that. For 2023, the maximum that your employer can reimburse you tax-free is 65.5 cents a mile. It's designed to cover your gas and maintenance, oil changes, all of those sorts of operating expenses of your vehicle. If your employer reimburses a lower amount, that's okay, that happens sometimes, but if you are the owner of your business, if you are an S corporation owner, you'll want to take advantage of the full standard mileage rate. If the business owns the vehicle, the most important thing is to track mileage for all vehicles that are being used in the business, whether they're 100% business vehicles or part personal, part business. Tracking mileage is key. A written mileage log is required by the IRS. If you get audited and don't have it, you can lose that deduction. First step is to note the odometer reading on January 1st every year. If you haven't done that yet for this year, we're 6 weeks into the year, 7 weeks, go figure that out while you're thinking about it. The IRS requires that on the tax return, we report both the total miles driven on that vehicle for the year and the business miles driven on that vehicle for the year. Make sure you have that information. Consider using an app like MileIQ. This is not a sponsored post, but MileIQ's been around for a long time. QuickBooks Online also has mileage tracking. Those electronic apps track all of your miles, all of your driving, and allow you to just indicate, is this a business drive or a personal drive, and makes it much easier. You can also do the old school way and have a mileage log book in each car to jot down the date, the business purpose of the drive, and how many miles are associated with that drive. Keep in mind that miles that do qualify to be deducted are the miles that are actively benefiting your business. You're visiting customers, you're buying supplies, you're traveling to a conference, you're stopping at the business P.O. box, you're visiting your friendly neighborhood accountant. Those active business operations miles. Miles that don't qualify are commuting, so from home to work don't qualify. Your general driving doesn't qualify, even if you have a business logo on your car. The cost of putting that magnet on your car or that wrap on your car is deductible, but it doesn't make all of your miles deductible. Picking up your personal lunch or running personal errands, those miles are not deductible, they are personal. If you're a business owner and you're providing vehicles to your employees to use for work, you still have to have that business log information. You still need to be able to establish to the IRS that the miles driven on that vehicle were business miles. If your employees are using that vehicle for commuting purposes or personal mileage, there may be some portion of that needs to be added into their wages as compensation. Definitely talk to an accountant if you're in that situation. The biggest thing that we hear is that dealerships advise you to purchase a vehicle over 6,000 pounds in order to take a big deduction. They are incentivized to sell you the most expensive vehicle that they can get you to purchase. There is some aspect of truth to this. If it's over 6,000 pounds with recent tax law, you've been able to take a deduction for the full purchase price of the vehicle. Keep in mind a couple of things. One, it's not a dollar for dollar deduction. If you're deducting a $50,000 vehicle, it might drop your tax bill $10,000. That's great, but it's not dollar for dollar. You still spent $50,000. It needs to be a vehicle that's being used significantly for business, not just in that first year, but long term. If you use that vehicle for business 100% in the first year, and we take that big deduction in the first year, in the second year, if your business use drops to 80%, 70%, 20%, you're going to end up recapturing some of that deduction, paying some of that back in the future years. Again, we're back to that mileage being really important to track. If you take that big deduction in the first year, it's locking you into taking your actual expenses every year from then on. You're not allowed to go back and use the standard mileage rate for that vehicle. The other thing to keep in mind is that taking that big deduction in the first year means that in future years, you're still going to be making payments on a loan most likely, but you're not going to have a deduction for that. So it can feel like you're paying more tax in future years on funds that you don't have in your bank account because you're still paying on a loan that you're not deducting. So most important, track your mileage. Make sure you have that written, contemporaneous mileage log throughout the year. Don't just give your accountant round numbers at tax time. It's not going to fly with the IRS. We don't like to do it. Let your accountants know if you have any questions. Let us know if there are questions that we can answer in future videos. Hopefully this was helpful. Have a fantastic day.